Most people hear the word recession and immediately think fear, job losses, shrinking savings, and uncertainty. For the average person, a recession feels like something that only brings pain and setbacks, and for many people, that's true. But history shows something uncomfortable that rarely gets talked about. While most people struggle during a recession, some people quietly come out stronger, wealthier, and more powerful than before. Those people are usually already rich or at least financially prepared. This isn't because they're smarter or luckier by default, it's because they understand how money behaves when the economy slows down, and they position themselves accordingly. A recession changes the rules of the game, and rich people know how to play by those new rules instead of fighting them. When a recession hits, assets drop in value, stocks fall, real estate prices soften, and businesses struggle. For most people, this feels like a disaster because their income is tight and their expenses leave no room for opportunity. But rich people see falling prices differently. They don't see loss, they see discounts. When assets become cheaper, they're able to buy what others are forced to sell. Over time, those purchases often turn into massive gains when the economy recovers. Cash becomes incredibly powerful during a recession. While many people are living paycheck to paycheck, rich individuals often have reserves. That liquidity gives them options. They can invest when others can't. They can negotiate better deals. They can move quickly while everyone else is frozen by fear. In uncertain times, flexibility is one of the most valuable forms of wealth. Recessions also expose weak businesses. Companies that were poorly managed or overly dependent on debt often collapse under pressure. For rich investors and entrepreneurs, this creates opportunity. Strong businesses can be acquired at lower valuations, competitors disappear, and market share becomes easier to capture. What looks like economic destruction on the surface often becomes consolidation behind the scenes. Another advantage rich people have during recessions is patience. When markets drop, emotions run high. Panic selling becomes common. Many people pull their money out at the worst possible time because they can't emotionally tolerate seeing losses. Wealthy investors tend to think long-term. They understand that recessions are temporary, even if they feel long while you're inside them. Instead of reacting emotionally, they stay invested or increase their exposure. Recessions also shift labor dynamics. When jobs become scarce, businesses gain leverage. For wealthy business owners, this can mean access to highly skilled talent that would normally be too expensive or unavailable. At the same time, operational costs often decrease, allowing efficient businesses to improve profitability even during economic slowdowns. Debt behaves differently during recessions as well. Those who understand how to use debt strategically can benefit when interest rates change or inflation reduces the real value of borrowed money over time. While reckless debt destroys people in downturns, structured and controlled leverage can quietly amplify wealth for those who know what they're doing. There's also a psychological advantage. Rich people are less stressed by recessions because their survival doesn't depend on short-term income. That mental clarity allows better decision-making. While others are operating from fear, wealthy individuals are able to think rationally, analyze opportunities, and make moves based on logic instead of panic. Recessions also reshape entire industries. Consumer behavior changes, inefficient models disappear, and new solutions emerge. Wealthy investors and entrepreneurs pay close attention to these shifts. They invest early in trends that are born out of economic pressure, positioning themselves ahead of the recovery instead of chasing it later. One of the biggest advantages rich people have during recessions is time. They don't need immediate results. They can wait years for investments to mature. This long-term perspective allows them to absorb short-term pain in exchange for long-term gain. Most people don't lose during recessions because markets fall. They lose because they're forced to make short-term decisions with long-term consequences. Recessions also tend to widen the gap between those who prepare and those who react. Rich people often enter downturns with diversified income streams. If one source slows down, others continue to perform. This stability allows them to stay active while others are simply trying to survive. Even socially, recessions create advantages. Networking dynamics change. Access to opportunities becomes quieter and less competitive. Deals happen behind closed doors. People with capital, patience, and relationships find themselves invited into rooms that didn't exist during boom times. What makes all of this uncomfortable is that none of these benefits are accidental. They're the result of preparation long before the recession begins. Rich people don't magically win because the economy collapses. They win because they structure their finances to survive volatility and take advantage of it. The real lesson here isn't that recessions are good or something to celebrate. They're painful for many people. The lesson is that economic downturns reward preparation and punish fragility. Wealthy individuals aren't immune to losses, but they're positioned to recover faster and capitalize sooner. If there's one thing history makes clear, it's that recessions don't destroy wealth evenly. They redistribute it, and the people who understand how money moves during uncertainty are often the ones who quietly benefit the most. In the end, recessions reveal how the system really works. They strip away illusions and expose financial habits. For some, they're a setback that takes years to recover from. For others, they become a turning point that accelerates wealth. The difference isn't luck. It's positioning, patience, and preparation long before the crisis begins.